today's presentation by giving you some background on CFSI and on the lab, and then go into some more detail on the FinLab applicants. Then Asad will share some key observations we came across as we delved into the data from our 356 applications this year. Finally, we're going to hear from Sheel and Caribou before we turn it over for audience Q&A. As you all know, CFSI is the authority on consumer financial health. We are the first center for innovation to leverage technology changes to improve the quality of financial services for low to moderate income Americans. This is particularly important and crucial work given the fintech revolution we are currently experiencing. We believe, more now than ever, that these issues and changes are going to continue to grow in importance. What is also exciting is that the industry trends we have seen in our own data demonstrate increasing attention and opportunity for un- and underbanked consumers. That is an area of expertise for CFSI. We conducted the nation's first study on the un- and underbanked. Our research on the state of Americans' financial health and tracking of the financially underserved marketplace has given us increased understanding of underserved consumers and the market opportunities to serve them profitably and responsibly. One outcome of this has resulted in our decision to champion financial capability as a more effective framework for driving consumer behavior change. This has successfully shifted both U.S. policy and practices on the ground. To promote improvements in this space, we work to identify innovations in areas such as transaction savings and credit, including by investing over $30 million in promising fintech innovations that improve the financial lives of everyday Americans. We developed a framework called the Compass Principles to guide the design and delivery of high-quality services. Along the way, we have built an incredible network of like-minded partners and providers. This financial health network is at the core of our work and includes 100 organizations that are stakeholders in the mission to improve financial health in this country. We have advised some of the largest brands in the financial services industry on products and strategy development, which in turn has improved the lives of millions of Americans. To learn more about us, please check out our website at cfsinnovation.com. For those who are not familiar, FinLab is a partnership between CFSI and FinLab founding partner, JPMorgan Chase. Through this program, we invest in and support leading startups and nonprofits that can improve Americans' financial health. We work with a number of partner organizations, including design firm IDEO.org and behavioral economics firm Ideas42, that support our companies. Strategically, we work with a cross-sector group of industry leaders that helps guide the direction of the lab, including Caribou, who we'll hear more from later. We are appreciative of the ongoing support from our partners at JPMC, and we could not do this without them. FinLab is set up to provide its participants with capital, access to expertise, and exposure to industry leaders and the regulatory community. We do this through a 9-month virtual program where we work with the companies hands-on and meet with the companies in person every 6 weeks. For example, we kicked off the program this year in San Francisco with a day-and-a-half-long meeting. The first thing we did with the companies was an experience called FinX. FinX is CFSI's hands-on simulation of the alternative financial services market. It is designed to give participants first-hand experience to the challenges faced by the millions of Americans who lack access to traditional financial services in a way that no presentation can. Tasks involve cashing 2 checks, 1 payroll and 1 personal, wiring money to another group member, loading and using a prepaid card, among other challenges. The groups quickly learned how difficult it was to complete the task in the allotted time, as well as were shocked by how quickly the fees added up for each service. This firsthand experience helps founders develop empathy for the consumers they are striving to build products for. It is very important to CFSI that we kick off each FinLab program in this way. We firmly believe that this empathy with the consumer is by far the best way to ensure products are designed with their needs in mind. The rest of the meeting was devoted to the companies presenting to each other about their products and learning about one another's goals, as well as meeting with our partner organizations to brainstorm and exchange ideas. The program closed with a panel of founders from our first FinLab class who shared their insights about the program as well as advice with the group. At the end of this month, this year's FinLab class are going to Chicago, where they will participate in CFSI's Network Summit, a convening for CFSI's network members. There, the companies will hear from speakers such as Adrian Harris, Special Assistant to the President for Economic Policy, and Dominic Venturo, Executive Vice President and Chief Innovation Officer at U.S. Bank, as well as participate on a number of panels and working groups. Through these meetings, experiences, and hands-on support, we strive to help innovators navigate the difficulties of this industry through our own expertise and with the help and support of partner organizations. Each year, we pick a consumer challenge to focus on. This year, we were looking for startups and nonprofits that help consumers weather financial shocks, a challenge faced by a majority of Americans. Financial shocks are unexpected expenses and drops in income. Over 100 million American households experienced a financial shock in the past year: a medical expense, interruption in income, car repair. This type of shock will cost an average of $2,000, and fewer than 6 out of 10 households have enough liquid savings to pay for an expense of this magnitude. A majority of those experiencing financial shocks reported that the shock made it hard for them to make ends meet. Without products to help households weather financial shocks, the effects reverberate through a family's finances, often causing long-term damage. We received 356 applications in response to this challenge. This slide gives you a visual of our selection process. We accept applications for several months following the launch of the challenge. After the application deadline passes, we spend a lot of time reviewing these applications. This involves several rounds of application review by persons within CFSI, JPMC, and our partners. Further along in the process, we interview teams by video chat or in person to learn more about them and their product or service that cannot be fully represented in an application form. Finally, at the end of the process, we have the top teams pitch live before a panel of judges. This process is rigorous, but it enables us to really get to know the companies and understand their products and services in depth. And it also helps us deepen our understanding of trends in the industry. Later on in this presentation, we will briefly mention the companies selected to be part of this year's cohort. In the next section, we will tell you a bit about our applicant pool as a whole and how it compares to last year's applicant pool. We were very impressed by the response to our challenge. FinLab Applicants this year represented a diverse set of organizations that employ an impressive breadth of technologies and innovations to help consumers weather financial shocks. As I mentioned earlier, we received 356 applications this year, which is 19% more than last year. Collectively, these organizations serve 4.2 million Americans, have raised $420 million, and have 2,300 people on their teams. They come from 34 states, and less than 40% come from the Bay Area and New York. The geographic distribution of this year's applicant pool is remarkably similar to that of last year's, and 24% of this year's applicants were repeats from last year. While only 9 to be a part of our 2016 cohort, these 356 applicants serve as the basis for this report. This group provides a unique window into the state of consumer-focused financial technology in the United States, and they help us understand trends in early-stage innovation in financial services and the implications of those trends on the industry and on consumers. Our applicant pool shifted in 2 important ways from last year's. First, the mix of for-profit to nonprofit shifted. Nearly 90% of applicants this year are for-profit entities, which is up 79% from last year. This is due to the fact that Fintech startups are being formed at a much quicker pace than nonprofits. About a third of our applicants were founded in the last 12 months. Only 5% of these new organizations are nonprofits. We're excited about the increase in startups, but we also want to encourage new nonprofit entrants. Nonprofit providers play an important role in the financial services ecosystem and can serve as a test bed of innovations in products and distribution models. Second, we saw a shift away from tools that help consumers plan, like personal financial management, budgeting, and education tools, and an increase in every other category. Savings saw the largest increase and represents the largest product category for this year's applicants. About half of all applicants say they help consumers save money. This fit our challenge well, as savings can increase resiliency in responding to financial shocks. We also saw a significant increase in insurance solutions, which was mostly nascent last year. Insurance tools represented almost 1 in 5 applicants this year. Our guest, Caribou, is a thought leader in the development of the insurtech space. We will hear more from him on this later. Many of these companies are early stage, and we are excited to see such a large number solving for an important consumer need. and we're looking forward to seeing how they develop. Also noteworthy is that nearly 2/3 of applicants identify their product as more than one category. This is a slight increase over last year. On two attributes, our applicant pool stayed eerily similar to last year's: team size and capital raised. This is likely a reflection of the fact that we're actively encouraging early-stage innovators to engage with FinLab. Average team size remained exactly the same at 6.5 people. Total capital raised increased slightly to $447,000. Last year, we noticed that companies based in the Bay Area had raised 1.7 times their counterparts in other regions of the country, even though they had a similar number of customers. This year, that Bay Area premium of funding bias increased to 2.7 times. So while fintech innovation is happening nationwide, capital continues to be more concentrated. This increase may be due to a number of factors, including rising cost of living in the Bay Area, but it is interesting that it's continuing to steadily rise. Next, we will hear from my colleague Asad, who will go over key industry observations.
Thanks, Kate. In this next section, we'll share some of the most noteworthy industry trends that we noticed while reviewing our applications. So while Kate talked about the quantitative, I'll focus more on the qualitative and what we think have broader implications on the industry. So in our process of identifying the trends that we thought would be most interesting and most noteworthy, we recognize that they actually kind of coalesce around a broader conclusion. And that conclusion is this: consumer fintech is maturing. Because of the sheer pace of new fintech entrants, Kate mentioned the number of new fintech startups that we're seeing in the space, and many of you are also seeing this. But because of this, these entrepreneurs are working harder to differentiate. They're being forced to. They're focusing on more complex products. They're thinking about more focused consumer segments that have underserved needs. And they're also thinking about scale in more sophisticated ways, which often includes partners like employers. So we'll talk through those trends now. So our first trend is that fintech products are getting more complex. Fintech has always been a complex area for entrepreneurs to go after, but we're seeing an increase in that. We observed a sharp increase in the number of entrepreneurs working on products that are subject to the most complex regulatory oversight, that are dependent on a whole host of partnerships, and that require really significant capital. So examples of these types of companies include applicants that were giving consumers access to instant approval lines of credit, ones that were reinventing loan servicing, ones that were offering and underwriting disability insurance in new ways, helping consumers navigate the confusing world of medical billing, and also helping immigrants with cross-border bill pay. These are just some of the examples of the more nuanced and complicated types of products that we were seeing. But there's another side of this, that they have to remain elegant on the consumer-facing side, and we'll talk about how they do that in a second. But what makes these consumer problems complex from an industry perspective and from a government perspective is exactly what's drawing these high-quality entrepreneurs to these problems in the first place. These are real consumer needs that incumbents have failed to solve. So they become a really interesting consumer problem for fresh eyes to go in and solve. One indication of this trend is something that Kate started to talk about a bit. You can see that in the chart shown here, you can see that our applicants shifted a bit. We saw less applicants that fall into what we call the planning category, and we saw an increase in the more complex product types like credit and insurance and payments. Those that identify solely as planning fell from 40 applicants last year to just 9 this year. These are the more basic budgeting tools and personal financial management apps that used to be a big part of consumer fintech. While those still exist, many of them are evolving to be more advanced and more multifaceted, to think about consumers' financial lives more holistically. A good example of this is 2016 FinLab company Albert. They give users a financial health score, which allows them to, and also allows them to see their financial history, which is a common feature that many tools have had in the past. What makes them unique is that they let consumers act on the advice that they're giving them on how to improve their score without actually leaving the app. It's a really elegant solution to be able to see your score. They tell you how to improve it, and they let you improve it in-app. They have a built-in savings tool. So if they identify that the first biggest need you have to improve your financial health is to improve savings, they'll let you actually set that up in-app. And then they also let you apply for insurance or credit products that are offered through partners without leaving the app itself. While this is an elegant solution for the consumer, the team has had to do a lot of hard work even before getting off the ground. Their MVP wasn't as simple as just offering a budgeting tool. They had to find the categorization and budgeting functionalities that others have had to use, but they also had to find a banking partner to host that savings for users and partner products that they feel could be useful for their customers. So there's a lot of business development and a lot of product work that went into this, even just to get off the ground. To us, Albert represents the new wave of planning tools because it lets users take action. So not only are you planning, you're actually able to do something about it. This type of complexity is inherent as we see an increase in hybrids, which is what we call the products that fall into more than one of these traditional product categories. So a good example of this hybrid is a company called Saldo. They enable U.S. consumers to pay bills for relatives in Mexico, and they also offer U.S. consumers the chance to be a secondary beneficiary on micro life insurance plans in Mexico. All of this is managed on the blockchain. While this is certainly complex and difficult to get into one sentence, this product hits on multiple key pain points felt by underserved consumers. Cross-border payments are really difficult and happen to be fee-ridden today. And this consumer base also lacks access to life insurance. They're solving really key needs and do it in a way that might be complex under the surface, but feels natural for the consumer. Lastly, it's worth calling out the innovation we're seeing on basic financial services. So products like transaction accounts or savings accounts may seem simple, but as many of you on this call surely know, these can be the most difficult products to innovate within due to the regulatory oversight. We saw a number of companies going after this. So 2 FinLab applicants are chartered credit unions. 1 applicant was planning on acquiring a small bank, and 2 applicants were actually planning on applying for their own bank charter. As many of you may know, de novo bank charters are exceedingly rare in this country in recent years. While only 3 banks have been chartered in the U.S. since 2010, we do see indications from regulators that we may soon see some degree of comfort with startup banks, if you will. And we're interested to see where this goes. It's B. So they're a FinLab company. It's spelled B-E-E. They themselves are not a bank, but they fall into this camp of innovating on basic financial services. They're making financial services more accessible to low and moderate income consumers by providing an alternative to checking and savings accounts. But they do this in the field. They actually work to expand the opening of these accounts with pop-up stands that are physically operating in the neighborhoods where the underbanked consumers live. So right now they're live in a few neighborhoods in New York City and in a few neighborhoods in the Bay Area. And they're seeing really interesting traction because they get to know these consumers on a one-to-one basis in person. Our second trend is that underserved segments are, that fintech companies are really going after new segments that have been previously underserved by technology innovation. So innovators are almost by their nature going after products where incumbent technologies are failing them in some way or another. One such underserved segment that receives significant media attention is the millennial generation. They're the biggest generation, and according to the FDIC, about 1/4 of them are underbanked. We also all see stats about how they tend not to open credit cards at the same rate, and they tend not to trust financial institutions at the same rate. So unsurprisingly, a staggering 26% of our applicants focus just on millennials as their consumer base. The company I mentioned previously, Albert, they're starting with millennials as the target customer. And another one of our companies that I'll talk about later, Wise Banyan, is also focused on the millennials. Because this consumer segment is so big, we suspect that we'll continue to see more companies targeting this segment. But perhaps more noteworthy is that many of the strong companies we saw this year are focused on customer segments that, unlike millennials, are still ignored by the latest and greatest in technology innovation. These tools are not just targeting the broad improvement of financial health or the broad goals of improving consumers' financial lives, but they are specific in how they help the consumer because they really go after the needs that certain segments are feeling, and they design their tools for the context and the needs of those consumers. So one group that we saw in particular that was getting some attention is ethnic and racial minorities. Nicole Sanchez is the CEO of a company called eCredit Hero, which is in our current cohort. They help consumers dispute issues on their credit reports. She talks openly about the fact that her target customer is Black millennial women, and you can see that in the quote that we have here on the slide. Even though the product itself has broader applicability for many consumers, the company's done a really good job of tailoring their messaging to talk about this consumer segment, or to talk to this consumer segment in a way that resonates. Most interesting is they talk about their users as community members, not necessarily as customers. And you can see this even in just the Facebook group about their product. You can see the type of interaction that folks have and how excited they get to work with this team and this product in particular. Another example that's focused on the racial and ethnic minority segment is a company called Money Neo. It's a bilingual website that empowers U.S. Latinos and Latinas with personal financial education. So their users can learn with culturally relevant and bilingual personal financial articles and comparison tools. So many of you know that these tools exist for native English speakers. Many of you may be users of such tools. But Money Neo goes beyond just translating those articles. They're thoughtful about the type of content that their consumer base will want to see, and the types of solutions that the consumer base will find most appealing and also most appropriate. So really interesting angle at the U.S. Latino and Latina market. But this broader trend about serving the underserved segments, it isn't just concentrated on ethnic and racial minorities. So one of the companies we saw was a company called Golden, which focuses specifically on the needs of American seniors. So the company targets 40 to 50-year-olds with the intent of pursuing them to use Golden as a tool to manage their parents' finances. So as many of you know, there's a macro trend in this country this country is becoming older. What's not as front and center for many folks is that this older, aged population in the U.S. is pretty economically vulnerable. About half of them identify as economically vulnerable. So it's not just an issue for the elderly, though, because their families get involved in taking care of them, which is a great source of stress. This is where Golden comes in. They solve that problem for the adult children, but also for the parents. So Golden itself, the product provides a free financial health checkup. It gives you access to credit reports, bill pay tools, and then it ends with a checklist that also includes an aggregated view of the parent's accounts online, so that the child gets a dashboard of what's going on in that parent's financial life. So you can see how this would save families time and money, but more importantly, it reduces a lot of stress that families feel in dealing with some of these issues. So to conclude this trend for a second, at CFSI, our mission is clearly to think about the underserved, but we were excited to see so many entrepreneurs that are thinking about this in new ways. Technology is always going after the underserved in one way or another, but we're really excited that this aligns with our mission and how we think about the work. And the third trend that we identified here is that many companies are looking to partner with employers as a strategy to scale. So for those of you who saw or read last year's Snapshot paper, we noted that many innovators were seeking access to employers as a source of scale, but that there was a lot of challenges in that business model. It's difficult to find these employers. The largest employers are often reluctant to meet with these companies. Admittedly, this has shifted in the last 12 months. Many in this year's applicant pool are seeing traction with employers. They're selling directly to companies as a potential employee benefit or something that their employees can use, or they're reaching these companies or these employers through integrating with their tools. So HR tools and specific like payroll systems and benefits portals. These startups will try to integrate into those so that large employers can offer their service. You can think about this trend by splitting it into two parts, thinking of it as a question of supply and demand. So part of this is an increase in supply. We're seeing more and better companies that are thinking about the employer channel as a source of scaling. But there's also an increase in demand. And the chart on the right here shows this most clearly. So Aon Hewitt is the largest benefits broker in this country, and they do a study of what employers are thinking about offering to their employees in the next 12 months. And they've done this study for many years. You can see that in the last 3 years, there's a pretty significant increase in the percentage of employers who are saying that, you know what, we do want to offer financial well-being benefits beyond just retirement. And for the first time, that's topped over 50%. So now we're seeing this demand from employers to offer tools to their employees that can actually help their employees in their financial lives. So those two parts of this trend are what's really driving this forward. So employers, they're seeking solutions, and then innovators are there to offer it. We see a diversity of product type that's trying to leverage this channel. So we're seeing employers subsidize loans, payroll integrated bill pay, financial coaching offered through the employer, and even rainy day savings match, which is almost like a 401k match, but instead of doing it for retirement, you do it for rainy day savings. So all these are really exciting types, and we're excited to see where else this goes. I'll give you a couple of examples to illuminate what's going on here. So one of them is a company called Simplify. So employers partner directly with Simplify to add customized employee wellness programs to the existing benefits package that's already offered to those employers' employees. Part of the value prop here is that employees' productivity drops significantly when they experience financial shocks. So when they themselves have an increase in expense, they have less hours available, the shocks that Kate referred to earlier. It's in everyone's best interest for that employee to not have to stress about those shocks at the workplace. So the employer is interested in offering something that can help with that. Simplify approaches this by having employers subsidize the cost of a loan to the employee so they don't have to dip into their retirement savings or use high-cost alternatives to help mitigate the effects of that shock. This is important because those financial shocks are something that in some ways are inevitable. Everybody's going to face them at some point or another in their lives, but it forces behaviors that have longer-term implications, and Simplify can help avoid those for consumers. Another example of an innovator that's innovating in this space is FlexWage. So they're an example of the second type where they integrate directly with HR tools. So their product is called WageBank, and what it does is gives consumers access to their accrued but unpaid wages between pay cycles on prepaid debit cards. So you might get paid every other week. It's day 7 of that pay period, and you need access to those wages. Well, WageBank offers a way for those employees to actually access a portion of those accrued wages early. This is particularly powerful, again, if you have a financial shock, but it's also powerful for folks who are living without much cushion, and that tends to be low and moderate income consumers. So this is another tool that's really interesting. What's most interesting about them is how they've approached getting to the employer. They're integrated with the marketplace on ADP, which is this country's largest payroll provider, and they also integrate well with benefits brokers today. That employers are recognizing this need to provide financial well-being is a trend we're really interested in at CFSI, but we're really excited to see some of the better startups that we saw this year offering tools that can help employers. We think that this is a difficult channel, but one that has a lot of potential benefits. So we're excited to see where this trend ends up. So those 3 trends that I just shared with you led us to the conclusion that in some ways FinTech is maturing, but we also found 3 particular trends that point to where FinTech may be heading. So we'll talk through each of these. In insurance, what we're seeing is that there's a wave of entrepreneurs who are attracted to it, but that it's still early days. This almost runs counter to the idea that FinTech is maturing because insurance is a large part of financial services in this country, yet the innovation life cycle there is still in its early days. There's a lot of folks interested in this space. A lot of entrepreneurs are interested in InsurTech And we're also seeing a lot of investors and ecosystem players excited about innovation in this space, in part because it's a huge market and it's a really key need for consumers. So this is one that we'll be paying close attention to. The second one here is the form of communicating with consumers. So about 10% of our applicants use messaging in one way or another as their primary source of communication. So some of these are aiming to be the true chatbots that leverage the latest artificial intelligence, machine learning, natural language processing, using tools like SMS or Slack or Facebook Messenger, or even custom messaging within apps. But others are just using messaging as a feature. They just use that as a primary way of helping the consumer interact. It may not be a natural language processing tool, but it's an SMS type of solution. So like many others, we're watching this trend with interest because this is a new way for a user interface to present innovation to consumers. We do have questions about what this means for business models. We're interested in watching, does this open up new potential business models and product types, or is it just another UI on top of the already existing business model? So that's where we're most interested. And the last one worth calling out here is that blockchain is being leveraged in new and increasingly interesting ways. The number of applicants that leverage blockchain more than doubled from last year to 20. But that still just makes up 6% of our applicant base. Nearly all of these applicants are still developing products or have yet to see any kind of scale. One interesting shift from last year to this year, which is probably reflective of where cryptocurrency and blockchain technology is going in general, is that last year we saw a lot of applicants that had the prefix bit or the suffix coin as part of their name. We would see a number of them that basically just talked about Bitcoin in the highest level description of their company, which is their name. We didn't see any of those this year. This year we saw a number of companies where you had to dig pretty deep to understand that they are actually leveraging blockchain as a technology solution, and it's more naturally woven into their operations rather than being front and center of what they're actually trying to do. We're seeing blockchain being leveraged for a number of use cases, but again, many of these are still pretty nascent. Cross-border currency conversion, complicated asset trading, record keeping, and accounting reconciliation. As this trend continues, we're excited to see the technology continue to mature in a way that might have benefits for consumers, but that consumers may themselves never have to interact with directly. And so before I turn it over to my colleague Ryan to do some question and answer here, I wanted to quickly talk about the 9 companies that we ended up selecting for this cohort. As Kate mentioned, we had a pretty rigorous selection process to narrow down the 350 applicants we had to this 9. But we ended up with a cohort that we're really excited about. Some of these I mentioned throughout as examples, but wanted to make sure I spent a minute talking about the others. So Albert, the first one on this slide, I mentioned as an example that's going after a more complex product type. They do target millennials, but they give users a personal financial health score that they can then take actions on to improve in-app. They're live in the iOS App Store today. Definitely recommend that all of you go download it and find out what your financial health score is. Company called B is another one that I mentioned as an example. They're going after basic banking services. They offer an alternative to checking and savings account. They are live in certain neighborhoods in New York City and in the Bay Area, and they're really going after unbanked consumers. We have one nonprofit in this cohort, and that's a company called Earn. They've been in the savings business for years, and they have really opened our eyes, and I think the industry's eyes, on the importance of having nonprofits as part of the ecosystem. They work with the most underserved consumers. They work with many of them face-to-face. And they also have a technology program that helps consumers match savings to really incent and really kickstart the savings behavior that they want to see in consumers. The next one is a company called Earn Up. They help consumers make more intelligent and more frequent payments to existing loans. So there's an idea here around micropayments, that your payments should match your income or your lifestyle more appropriately. You might get paid every week or every other week, but your mortgage payment is only once a month. They can help match those things so that it more aligns to where your lifestyle is headed. Company called eCredit Hero, mentioned them as an example of going after specific consumer segments. So they focus on Black millennial women, and they help consumers dispute errors on their credit report. There's a company called Everlance that helps those in the 1099 economy track their mileage and expenses in a really elegant way that sits in the background but really has big benefits for that consumer segment. Next is a company called Remedy, which helps folks manage medical billing. There's all types of confusing coding and many errors on a lot of this, on a lot of medical bills, and Remedy helps folks understand it and also dispute the errors. A company called Scratch is doing loan servicing. This is something that impacts consumers, but that many don't realize can have a huge impact. And so we're excited that they're building a modern-day loan servicer. And then last is a company called Wise Banyan, which is the world's first free robo-advisor. They're targeting millennials, but their whole idea is robo-advising is just one part of it. Investing is just one part of it. They want to be the front door to a consumer's financial life, and this is how they get that consumer. So we're really excited about these 9 companies and what they're up to. But I will now hand it over to my colleague, Ryan, who will go into some question and answer.
Thanks, Asad and Kate. Appreciate it. And now we're going to shift to a Q&A session. And we've got a couple of questions queued up. There were a number that came in during the presentation, so we'll try to consolidate those and get them answered. But if there are other questions in the audience, a reminder to just use the little question panel on the GoToMeeting screen, and it will pop up, and we'll try to get it in front of either Sheel, Caribou, Asad, or Kate, depending on who it's most appropriate for. So at this time, I'd like to welcome Sheel and Caribou. As I mentioned at the top, both Sheel and Caribou are leading venture capitalists in the financial services industry. Sheel is a former 2-time successful founder and is now with 500 Startups, leads our Fintech program. Caribou was really one of the leading thinkers in the financial services industry, really influential early in his career in helping to develop and build Capital One, which is one of the country's largest financial services industry companies, and has extensive experience both here in the United States and internationally. And so we've invited them to join this call to provide a little bit more context of kind of what we saw in this industry and how this fits into the broader ecosystem. Both Sheel and Caribou have remits that go beyond just consumer fintech, and I think to a degree get a bit more exposure into other areas in kind of the funding cycle and technology. So Sheel tends to be a little bit earlier than we are, sees a lot more companies, while Caribou QED tends a little bit later and goes a lot deeper with firms. And so we thought that they would provide a bit of context how to think about what we're seeing. So now, Sheel, let me start with you. I should thought that Albert was a company that came through 500 Startups in your first class last year and is now part of our program. But I think one thing that's interesting is you are a pure commercial investor, but your focus for 500 Startups is fintech for the rest of us. What does that mean? Why are you interested in this market? And I think one question did come in early on is how are socially responsible investors, impact investors thinking about that? I'd love for you to maybe provide some color on kind of how you see your role versus that market.
Yeah, that's a great question because people sometimes. So first of all, I wouldn't necessarily classify myself as an impact investor, but I think people hear impact investor and they think impact could come at the expense of returns, and that's not really true at all. So for what I do, financial services for the rest of us, I just think there's an opportunity to have outsized returns because the traditional financial institutions have not served anybody. Well, frankly, they haven't served anybody well, but they have done a better job at serving what I'll call old white men globally. And aside from old white men, there are a lot of people, and as you know, a number of your companies service sort of minorities and just younger folks, millennials, and so I think there's actually just a tremendous opportunity to have outsized returns by serving these people effectively.
You know, you see a broader kind of purview than we do. I mean, what trends are you seeing that we didn't identify today? Is there anything that popped out in your mind?
You know, it's actually I think your trends are pretty similar to what I've been seeing in the marketplace. There's a lot of, and Caribou is probably better equipped to talk about insurance, but there are a lot more insurance startups this year than there were last year. And sort of, I completely agree with everything that you guys said. Products are more complex. There are a lot of companies I've seen in sort of particular niche underserved markets. One challenge I've had is sometimes those underserved markets are actually, you know, too small for me to get very excited about. But I think generally speaking, if you're building a product for a large enough market, so you know, for Nicole it's Black millennial women, or for another company it might be Hispanics, I think those are huge markets and growing, and Nicole will move beyond that market as well. So I think that is a good market. And then the third piece, employers providing scale, I'm seeing the same thing. So I think you guys are seeing a pretty good cross section of the market, sort of similar to what I'm seeing. Probably more numbers, which is actually probably just more noise, but similar sort of outcome.
Yeah, well, that's really helpful, and we'll come back to you. I do want to kind of pick up on a point you made around insurance. You know, Caribou, I want to bring you into the conversation. You have a pretty wide purview of companies. I mean, you have some international ones. You've done a lot of work thinking about big data and incorporating that into credit decisioning and, you know, consumer marketing. But over the last couple of years, at least last year, you've gotten particularly interested in insurance. I'd love to ask you to kind of dig a little bit deeper into that, and then maybe provide a bit of color into how you see what's happening here in the U.S. market in contrast to some of the stuff you've seen internationally.
Sure. Thanks, Ryan. So look, on the insurance side, we started investing in insurance back in 2011. Right? Actually did an early deal in automotive telematics. And, we sort of, I want to say, dabbled a bit in the insurance sector, particularly while a lot of our attention was on the innovation going on the lending side of fintech. But about 18 months ago, we really saw, it really hit us, that the insurance space was about where the lending side was 5 or 10 years prior. Right? That is to say, it felt like it was just on the verge of being ready to explode in terms of lots of interesting innovation, the sort of appetite for risk from the venture community, the really interesting, capable entrepreneurs starting to swarm into it. And so that led us to say, look, this is something we want to make sure we are part of and supporting. I think that we are seeing innovation and efforts by the entrepreneurs across every part of the value chain. Even just last week, I was talking to some folks who are trying to make the reinsurance market more efficient, right? And that's something which is sort of deep in the bowels of the insurance industry. That's so far from being consumer facing. And then we're seeing efforts across not just the sort of usual categories like auto and life and health, but then we're also seeing a lot of activity in more niche categories, as well as the small business commercial side of insurance. So really seeing all across the board efforts there. So I think it is one of the most exciting parts of the fintech story, probably for the next 5 years at least.
And we have a kind of a timely question actually from the audience that just came in about this, and that's how much of the activity in kind of the insurtech, but maybe even broadly more fintech space is collaborative with the incumbent players versus incumbents. I mean, are you seeing incumbents moving into these underserved area markets or in less efficient markets?
I think that's a great question, and you got to look at it from both sides, from the startup side and from the incumbent side. Right? If you're a startup, and you want to do big things in the insurance space, you're either faced with, the classic, do I try to become a carrier? And maybe someday you do, but it sure is hard to sort of solve all the requirements of capital and regulatory hurdles, in your Series A of venture capital. So I think that the startups are looking to find partners in the industry. They're not resistant to it for the most part, and most entrepreneurs are saying, look, it's just about finding the right partner who's going to have both the mindset flexibility and the technological capability. Right? There aren't many APIs in the insurance space right now. Yeah. And that's one of the challenges for the startups who want a partner. Now, on the other side, the incumbents, I got to say, I think that the insurance companies and reinsurance companies out there, for where the innovation stage is, I call it second inning right now, they're a lot more aware and keen to do something than the banks were when it was second inning in lending. Now, I don't know that the insurance companies entirely know what they want to do, but they know they want to do something, and that's actually the first step there. You're seeing a few of them being very aggressive, actually, in partnering. Munich Re comes to mind as an example. You're also seeing a lot more of them. I could probably rattle off a dozen of them, having set up pretty material venture capital arms, right, sort of strategic corporate VC arms, in-house, and being very active and making some really nice investments out there. So again, I think that actually more than I've seen in the other parts of fintech, there is, in many different forms, partnering and engagement happening, and opportunities for it to happen more and more between the startups and the existing players.
That's really helpful. And we actually got a very interesting, somewhat related question to this around the nonprofit side of things. Asad, I want to bring you back to this and maybe direct this at you. We've got a number of nonprofits in the CFSI network, whether they're community organizations, large national organizations like CFSI. This question is, what can nonprofit service providers who are serving underserved markets do to become more involved in fintech, in particular while ensuring that they're protecting their customers from maybe not the best actors, while also making sure that these products are appropriate. I'd love if you have any kind of thoughts. We've tried to struggle with this, and so it'd be great to hear your color on it.
I think that's a fantastic question, and I think it kind of goes back to what is the role of the nonprofit in the ecosystem. We've seen a couple of use cases that are particularly compelling where nonprofits have an advantage over the for-profit industry. I think one of those is serving the most underserved consumers. Right? There are particular products in particular consumer segments that may not be profitable in the near term, and that's where nonprofits can be in those communities, can work with them face-to-face, and get to know that consumer segment in a way that many startups don't have the incentive to, because the profit motive is harder to get to. And I think the other one, to more directly get to the person who's asking the question, what they're trying to get to, I think there's an angle here of nonprofits can also act as a proof of concept. In a way, them partnering with fintech companies and even with incumbents can help uncover what types of needs exist in many of these communities where the for-profit entities don't get to. So they can help say, these are the types of things we need to do. We've been trying this in person, and that can help spark ideas for profits or even for the nonprofit if they want to go build that. So they have an interesting role to play, but I think the question always goes back to how do they interact with the ecosystem? And I think the best nonprofits we see, for example, Lee Phillips, who's the CEO of EARN in our current cohort, she always says one of their biggest things is to affect society-level change. They're serving a handful of consumers that really need it, but the broader goal here is to show that savings can be affected by innovation, and I think they're doing that really well.
A follow-up came from this, again, an audience question. Is there things that, and this is from somebody who works in government, is there things that, policymakers could be doing to, maybe address some of the information asymmetry? I think people like Sheel and Caribou and ourselves, to a certain extent, have a great deal of knowledge about kind of the industry. What could we be doing to help kind of communicate this to the nonprofit community, Asad?
Yeah, I do think it's almost incumbent on organizations like us, and Ryan, I know you and I have talked about this quite a bit, of what we are doing, what we can continue to do, but I think there is at times a larger gulf than there needs to be between the startup community and nonprofits, and I think part of the way it was framed as information asymmetry can be overcome by just folks working together, and I think there is a willingness. We've heard from a nonprofit that, they're starting to recommend some of these fintech tools to their clients, and there's a great feedback loop that can be closed to then communicate that feedback that they're receiving back to the startups. And one of our colleagues here at CFSI is working on that, on how do we more formally systematize that so that the feedback loop exists from nonprofit client to the actual developers who are working on the tools. So I think part of it is just more conversations.
Yeah. I'm going to shift gears a little bit. Sheel, a number of questions around early stage investment. When should founders start thinking about going to an institutional investor or a program like a 500 Startups and Accelerators that's focused on that first stage?
Yeah, sure. So we consider ourselves a little bit. There's the definition of seed has shifted over time into, it used to be that you needed millions of dollars to get things off the ground. Now you literally just need maybe almost no money, hundreds of thousands of dollars to get off the ground. So the place we like to play is where there is a product. Typically the product is live, doesn't have to be, but there needs to be a product that I can see, and it needs to solve a problem for a specific target customer. We particularly like to see businesses that are capital efficient, meaning they can get operational with less than $1 million in external financing. And the stage that makes sense for us is, and by the way, I'll talk to anybody, even at the idea stage, but where we tend to invest is where we can see a product. They've done some early customer development, but they haven't necessarily nailed product market fit yet. And where we really help is in helping do the customer development and then grow the company. So we have folks on staff who are just dedicated to helping our companies grow, and I think that's sort of how we differentiate ourselves. And the point is to get to measurable traction, whether that's engaged users or revenue, or sometimes in fintech the traction may just be some sort of regulatory traction. And the point is, while they work with us they work in our office for 4 months, the point is to get some measurable traction that you can go out to investors and say, hey, we've really accomplished something.
Yeah. Caribou, I'd love your thoughts on this question. Where do you guys like to start working with founders?
Yeah, so I like to work with founders really early, but I don't like to invest in founders really early. And I make that distinction because I do like to get to know the entrepreneur, and I want them to get to know me and my partners long before we really think about writing a check. And that's partly because I want to see if they can deliver what they say they're going to deliver, and I want to see if we can actually be helpful to them along the way. And if both of those things are true over a course of 6 or 9 months, then I think it's actually a great sign that we could be the right investor for them. I also like to say, I think we're probably a little worse than average, maybe a lot worse than average, at giving an entrepreneur credit for their great idea. An entrepreneur and some PowerPoint is just really tough for us to get conviction. But I like to think that we're at least a bit better than average at giving an entrepreneur credit for great test results, right? And sort of understanding how to extrapolate from a small bit of empirical data. That probably hails back from our Capital One experience, where we might send out 50,000 pieces of mail to test some hypothesis. And if it works, then 2 months later, you want to send out 5 million or 50 million pieces that just look just like it. That's the sort of operational training that we've got, and we try to, sort of build on top of that as we select investments.
And then, one last question. I think a couple last questions. Sheel, you might be well positioned to answer this. Fintech for real estate. I know that you have a company in your batch right now that does this. We got a number of questions on what's happening in this space. Are you seeing a lot of activity? Do you have kind of a thesis here?
Yeah, we are seeing a lot of activity. So just another sort of informational piece that might be interesting to listeners. I run a survey of fintech investors, sort of friends. Every quarter, I ask about 25 investors to give me their feedback on what they want to see and what they don't want to see in the space. And the July survey, the number one thing that fintech investors wanted to see was insurance startups. And the number two type of company people wanted to see was real estate tech. And so that sort of just guideline overall on what investors like. What they don't like is at the bottom of the list was blockchain startups, and second from the bottom was payment startups. So just that might be interesting tidbit of knowledge. In terms of what I'm seeing in real estate, it's really at every level. It's from simplifying the mortgage process to lead gen. I've got an insurance company that's also in the real estate space. It's homeowners insurance companies. So I think real estate is very linked to finance, of course. So and it's a huge portion of the economy. So there is a lot of interest in real estate tech.
Interesting. And one more question. I want to bring this back to give Kate the last word here. A number of questions around policymakers, regulators. Kate, you were on Capitol Hill for a number of years before you came to CFSI. What are you hearing? You're in DC about this space. Can you give the listeners a little bit of sense of kind of how we're engaging with the policymaking community and kind of what you read on how DC is viewing kind of fintech?
Hey, that's a great question. I actually want to go back to a point Asad made a little bit earlier about dialogue. I was at a summit earlier this week on marketplace lending and on policy and marketplace lending, and one of the members of Congress who spoke there, was saying to the audience, if you all don't talk to us, you are going to get the laws and regulations essentially that you deserve. And that, that did get a bit of a laugh, but, his point was well heard that, Congress has been, everybody knows Congress has been really tied up and has gotten a really bad reputation for not moving. But we're coming up to an election. We're going to have a new administration. We're going to have a new Congress coming in. And they have started getting involved in fintech. Conversations are happening. The legislation is being introduced. And I think it's really important that everybody, the innovators, all interested parties, employers are engaging with members as these issues become more relevant, and particularly on the issue of consumer protection. That came up repeatedly at the summit the other day, and I've seen that issue hounded upon, which makes a lot of sense because these members are looking after their constituents and their constituents' concerns, and they don't want to be supporting efforts that are going to end up with lots of bad press. So, I think one really, great thing that innovators and others can do is just signal their good intent. So, for example, if an employer is engaging an innovator to provide tools for their employees, they should make it very clear to those employees that they're not required to use these new tools, even if the tools are intended entirely for the employee's benefit. They need to, make the options that they have very clear, especially because their employees, especially if they're lower income employees, may not have access to internet at home, or they may have a earlier model of mobile phone, or something like that. And actually, the innovators too should consider that when they're creating products that they're. I think that that signaling a positive intent is the best thing that can be done. And again, just keeping that open dialogue, answering questions, and engaging with lawmakers, as we go into 2017.
Great, thanks, Kate. Well, we're at time, and I want to say thank you to Sheel and Caribou for joining our presentation today, and I'll hand it back to Asad to close out.
Yeah, we to conclude, thank you for joining. We appreciate you all listening to what we have to say, and we hope it's been insightful. You can download the full report at the links that we've shared here. We'll also send that and a recording of this webinar to you shortly after the call. If we can be helpful, please feel free to reach out. You can find more information and our contact info on finlab.cfsinnovation.com. We look forward to hearing from you.